Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Have you ever heard that saying, all ships rise and fall with the tide? Well, in our industry, this is what we call systematic risk, or beta, which I'm going to explain here in just a minute. So here's the idea. Let's say that I'm in an index fund that's tied to the S&P 500. Okay, this is an index fund that basically owns the S&P 500. Now, if I'm comparing that with the benchmark itself, or the index S&P 500, you would expect that index fund is going to go just like with the market, right? So if you see the S&P 500 rise, 2-3%, you're going to see that index fund rise 2-3%. For the most part, right? Think of a mutual fund that's made up of large company stocks. If a large portion of those stocks are the S&P 500, you would also believe that if the S&P 500 went up 2-3%, that most likely that mutual fund invested in the same would rise about the same. This is what we call systematic risk. The idea that that your portfolio is going to be pretty much going with the market. Now, that's a good thing if the market's cooperating. If I see the market do well, and I'm watching that benchmark, I know my portfolio did well, right? But what if it's the opposite? What if I'm watching, the market going down? I could probably expect my portfolio to be going down right along with it. Now, the ideal thing would be to have it go up with the market, but not have it go down with the market, right? Now, we have the ability to get behind any portfolio and actually find out what its beta is, okay? B-E-T-A. What it is you take a beta of 1.0, and that means that portfolio is basically going right with the market. If the market goes up 2-3%, you can pretty much expect that portfolio to go up by 2-3%. If it's down by 2-3%, you should expect it to be down by 2-3%. Now, a beta score of less than 1, okay, maybe you say it's 0.8, means that it's going to be less riskier than the market. So market's up 2-3%, yours should only be up 1-2, all right, and vice versa on the downside. Now, a beta score of 1.0 or more means that the portfolio is more riskier than the market. So it's going to possibly do even better than market, but probably do even worse than the market. So knowing the score is very important, because if you have a well-diversified portfolio and at the end of the day it has a beta score of 1 and it's pretty much just tracking the market, well, if that's what you want it to do, that's a good thing. But if it's on the downside, if it's not what you want to do, maybe that's a bad thing. So I encourage you, if you're somebody that doesn't know that score, doesn't know how your portfolio would operate as it's compared to the market, then give us a call. We'll gladly analyze that portfolio and tell you what your beta score is. Listen, markets are cyclical. You'll have long periods where the economy is in expansion, and then it's typically followed by contraction. What things go up and sometimes things go down. That's the way the markets roll. But what is not acceptable is when there's clear evidence that the market is maybe heading into recession or a slowdown, and most advisors are sitting back saying, hey, just stay the course. Listen, most are trained to follow what's called a buy and hold strategy. They figure that if they just get you well diversified, then when you hit periods like that, you should just hold the line, right? Unacceptable. If you look back in 2008 when the market dropped to half its value, it took almost 5-6 years to get back to where you were at. And if you're somebody near retirement, in retirement, possibly taking income from that portfolio, that's not going to work. So when there's clear evidence that we're entering into recession, we believe adjustments are necessary. So I encourage you, when times are good right now, take the opportunity, give us a call, let us sit down with you, see how you're positioned to make sure that that can't happen to you.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Welcome. In this segment, I want to talk to you about what are called Roth IRA Recharacterizations. Okay? Now, I don't want this to get confused with Roth conversion. Okay? A Roth conversion is when you're taking a portion of your IRA, paying the tax on it, and then converting it over to a Roth IRA. Okay? I also don't want this to get confused with Roth contributions. Okay? Those are those amounts that are limited that you can do by the tax filing date. I think now $7,000 is what you can put into them. Now, those are limited, but on Roth conversions, there's no limit. Now, in this segment, I'm not going to get into what are the values of having a Roth IRA. If you've watched any of our shows before, hopefully you know that by now. But I want to specifically talk to you about what are called Roth IRA Recharacterizations. This is when you've done a Roth conversion, and typically you have to do these in the calendar year. Okay, you've done that. Now, in the old law, this is pre-2017 tax reform, if you decided that that was a bad idea, you had all the way to the second extension filing date to undo it, or recharacterize it, as they call it, act as if it never happened. Now, I want to give you a gross example of where that might happen for somebody. Let's say they had a $500,000 IRA and they decided to convert it to a Roth IRA. So they paid the tax on a $500,000 to get it over here into their Roth IRA. Okay? And then that next year the market tanked. Let's say it dropped to half its value. Well, I feel pretty stupid now, right? I paid tax on a $500,000 and now it's in my Roth IRA worth half the amount. Okay? Well, under the old rules, I could recharacterize that, undo it, act as if it basically never happened from a tax standpoint. Okay? Now, with the new actually a couple years old now, 2017 Tax Reform Act, that's no longer available. So if we do a Roth conversion in the calendar year, we're now stuck with that. So we got to be very, very careful what kind of accounts we use or what amount we use, because I can't change it after the fact. So tax planning is going to be very, very important. If you're going to be somebody that wants to take advantage of this, one, answer the question, should I or shouldn't I? But then two, make sure you don't get the amount wrong or get an account that's going to be too volatile that it can drop in value after you've paid the tax on it. Now, with that Tax Reform Act of 2017, it left a huge opportunity for these Roth conversions because most people are enjoying a 3% or more reduction in tax rates, which are just going to sunset and go back up. So this kind of planning, very, very important. I encourage you, if you're somebody that wants to know if you're a candidate to do it and want to make sure you're doing it right and you don't make any mistakes, then I encourage you, give us a call. We'd be glad to meet with you.
Larry shared some great information there about systematic risk and no longer having the ability to do these Roth recharacterizations. And it's very important for us, and the whole purpose of our show here at Retiring Well is to help you plan to retire well. And so we're covering a number of different topics, but some of these are pretty vital when it comes to your retirement planning and how you plan going forward. So one of the key areas that I want to focus on, and Art, I think it's valuable for us to talk about, is this idea of the Roth IRA and recharacterization, how that's no longer available. And so maybe walk us through, Art, a little bit more about actual Roth conversions and so what that looks like.
Right. You obviously, Larry talked about the Roth recharacterization, but I think it's important to understand what is a Roth conversion to start with. You know, we talk a great deal about that because it's big for tax planning for us here, but you know, when you're taking an IRA, a pre-tax instrument, and converting it to an after-tax instrument. Obviously, there's going to probably be taxes owed at that time, but we talk so much about tax bracket optimization, and you've probably heard us dwell on that over the years. But what's interesting in the times we find ourselves in with the recent market volatility and all that is thinking of it from a market performance perspective. You know, think of it this way. If I have, let's just make up a stock, XYZ, and it was worth $100 a share, and now it's worth $50 a share. Well, think of that. If I have the same number of shares, but my account value has dropped, what am I actually converting? Well, you're converting at that time you do the Roth conversion. So potentially, you know, it depends on your situation, but possibly a prime time to do conversions when the market is down some versus when the market is higher. I can convert the same number of shares, but at a lower value, thus potentially creating a lessable tax event. So
yeah, and so that's something as you're listening to this, and maybe you've experienced that before, the idea of a Roth conversion, or maybe it's something you haven't ever crossed that bridge before. That's where we encourage you to give us a call. We're happy to jump on the phone with you, or depending on capabilities, if we can sit down again together at this point in time, but just to talk through sort of what your situation is and maybe what some of those planning options may be. So stay tuned as we're going to be diving into when can I retire as well as bonds. So stay tuned to Retiring Well.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you may want to manage it. Use it to fund your dreams. Make it last as long as you need it. And leave some for those you love. So what do? Wall Street continues to be uncertain, and some conservative options have dropped through the floor. How do you maintain opportunities for growth and reduce risk of loss from market changes? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies and guaranteed retirement income you cannot outlive, provided by the claims-paying ability of insurance companies. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a complimentary consultation, simply contact us today.
Have you ever wondered when you can retire? Listen, this is a question we get asked a lot. Folks will come into our office, they'll say, listen, this is what I have, can I retire? Folks, there's a lot of different things that have to be considered. The first thing that we have to ask is how much income a person wants. You know, what's the lifestyle they want to enjoy when they're in retirement? We've got to start with that because I got to have a picture of how much money that's going to be and what that looks like. The second place I want to go is I want to look for sources of income. You know, do I have pension income? Do I have rentals? Do I want to still work part-time? Do I have sufficient savings? I want to, Social Security, what's that going to look like? So I want to look for sources of income. Another thing I want to look at is debt. Am I going into retirement with any mortgage debt or any other kind of debt that might, you know, hurt my cash flow when I get into retirement? So we're going to have to look at that. And then again, savings. You know, how much did I put away in those IRAs, those 401ks, those 403bs, those 457s? You know, how much do I have there that I can count on? And then there's another factor we want to look at is health insurance. All right, if I'm not at the age of 65 and can receive Medicare, how am I going to bridge that gap if I'm stopping working and having health insurance? You know, where is that going to come from? So we want to look at that. Inflation. You know, I might have all the means to pull together a plan today, but with inflation, is it going to be able to keep up with it over time? If I live another 20, 30 years, the purchasing power I have today is going to look much different down the road, and maybe I want to be, you know, having that, you know, put into my plan as well. Income taxes, you know, if I've got all my money in IRAs and now that's the only place I can pull income from and every bit of it is going to be taxed, Well, what does that look like, right? Or maybe I'm somebody that's fortunate enough to have other buckets of money, let's say non-qualified money, or what's really called non-retirement money. Or how much do I have in Roth IRAs where I can pull and not have it be taxable? And what's my tax plan as I begin to take that income? And if it's all going to be taxable, well, isn't that going to affect things as well? Can you see that there's so many factors involved in making that decision as to whether you can retire? And so I can't stress enough, having an income plan is so vitally, vitally important. You know, you should be looking at this 4 or 5 years before you pull the trigger, just so you know what it looks like. Or if it has some deficiencies, you have ways to correct it as you approach that date. So if that's you, as you're approaching retirement, you're maybe 4 or 5 years out and you're wondering whether you can pull the trigger, then I encourage you, give us a call and we can sit down and develop some kind of a plan for you before you decide to do it.
If you're retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no obligation retirement review.
Welcome back. In this segment, I want to talk to you about bonds, or what we call fixed income instruments or financial instruments. Listen, there's all kinds of bonds. There's what they call government bonds. Government bonds are simply bonds that are backed by some kind of governmental unit, whether that be a municipality, a state, federal government. Okay? Now, bonds can also be corporate, or what we call private. These are bonds held by that corporations issue. Okay, bonds for the most part are debt instruments. Okay, they're backed by the full faith credit of the person that issued the bonds. So if you're getting a corporate bond, it's simply backed by that corporation. Now, most generally in the financial world, bonds are considered safer than stocks. And here's why. Because it's a debt instrument, it actually in a case that company was going bad or went in default, bonds get paid before shareholders get paid or stocks get paid. So, and in case of a governmental unit, they can tax the people to pay that bond. So for all practical purposes, for the most part, bonds are usually considered a lot safer than stocks because they get paid off first in the event anything goes wrong. So credit qualityness is going to be a very important factor. It used to be said that, municipality bonds were, were all safe. Because they could be backed up by the municipality. But now we're seeing municipalities file bankruptcies. So, are they all that safe necessarily? So credit qualityness is going to be a huge, huge factor, especially when it comes to corporate bonds. How solvent is that company? How good is its ability to be able to pay that bond back? Well, that can be measured. We can do that through an analysis to see, how those rate. You have to understand too, bonds are interest rate sensitive. When rates are rising, bond values can go down. You say, well, how does that work? Well, let's just say I'm holding a bond today that's paying, let's say 3%. But tomorrow, because the interest rates rose, interest rates went up to 4%. Now I can get a bond paying 4%. Who wants my bond paying 3%? So they're going to adjust the value of that bond accordingly for all the lost interest that I'm not going to be able to get with that bond. So as interest rates rise, bond values can go down. Now, the taxability of bonds is a huge thing as well. If you're in a federally government-backed bond, it's usually going to be state tax exempt. If you're in a municipal bond, state bond, it could both be federal and state exempt in some cases. So there's a lot that happens with bonds. I hope this was valuable. But if anything, if you've got a strong bond portfolio and you want to just see how it stacks up as far as credit quality and this and that, then certainly give us a call.
What two wonderful segments there. You know, the one I think that speaks to so many of our clients and probably so many of you out there is, when can I retire? You know, it's a dream that many of us have from the day we start working. You think about retirement, and as that dream gets closer and closer to that day, you know, well, I think the anxiety ramps up. And what are those things that you have to work about? And what is this paycheck going to look like coming in? This dollar amount I've been saving for all these years, how can that provide for me and my family? You know, in times of recent volatility, we hope that your portfolio is positioned in a way that maybe this doesn't change your time horizon, but some of you it may have. And so I think it's all the more times like this remind us it's critical to have a retirement plan. And that plan is not just a number on a 401k statement. That plan is mapping out income not only now, but for the next 30 years. What does that look like? How is your portfolio designed to produce that income? What is your tax consequences going to be during that? What does it look like when you're gone? All of these things need to be answered before we really can answer that question, when can I retire?
Yeah, and I think one of the key points that Art just brought up is structuring an income plan. And I'm a visual learner, and so for me, when I like to lay out what does your income plan look like in retirement, it may be a matter of using buckets of money and basically saying, okay, here's a bucket of money where that's going to provide your income here for the short term, maybe the next year, 2, 3, 4, 5 years, whatever that may look like for you. And so you've got that. Then you've got another bucket over here that maybe is that a little bit more conservatively structured bucket where, okay, you're not going to have as much volatility going on during crazy times in the market. So that money is going to be there for you for those period of years. And then maybe there's a third bucket where, okay, this is money you're probably not going to touch for the next 10 or more years. And so with that, you might experience some ups and downs, and with that though, it's money. Keep in mind that you're probably not touching for a longer period of time, so you can weather through that. And the other piece that I always think of too is, what about that money that you have in the bank account, the checking, the savings that you haven't been building up much interest, and maybe you're fortunate enough where you've sort of tucked that aside. Well, now might be a time where you consider using some of that for income while letting these other buckets hopefully grow. So again, very important when it comes to your retirement planning. And again, as you're sitting there and hearing us talk about all these different ideas when it comes to your retirement planning, our goal is to help you plan to retire well. And so we encourage you, just call the number on the screen. We'd be happy to discuss your specific retirement plans. We look forward to helping you plan to retire well.
Hi, welcome to Tract Talk. Listen, in this segment, I want to talk to you about load fees in mutual funds. Now, as I show you this, I want you to understand that all load fees are different, but hopefully it'll give you kind of a feel for how these commissions are charged based on the class share you're in. Now, most mutual funds, you'll see, they'll describe the mutual fund, and then following it is like an A, a B, or C. That's the share class or the mutual fund you're in. So knowing this is very important. So out there they have what they call A shares. Okay, now A shares typically have a front load fee. And just as an example, I'll show you that they can be maybe 4 to 5% up front. That means as you put money in the mutual fund, there's a commission or a sales charge being charged right up the front that's coming off it, which is maybe 4 or 5%, for example. Then they have what they call an annual commission, or what they call a 12B1 fee. Typically on these A shares, that might be maybe, you know, 1/4%. Okay, that's just their annual commission they're going to charge on that share class. But there's usually no backload associated with it, meaning you pay the commission up front, you know, that maybe that 4 or 5%, you have your annual commission, but then forevermore you don't have any commissions other than that 12B1 fee. Now there's what they call B shares. Okay, now B shares are where you pay nothing on the front, there's no front load, okay, but the annual commission or the 12B1 fee might be, let's say for example, 1%. Now again, that can be different, but you know, just as an example, that's what it might be. But then there's what they call a backload, meaning depending on how long you've been in, it could be 4 or 5, 3, 2, maybe 1%. Meaning once you get to a certain period of time, let's say 5 years, then there's no longer associated with it a backload. But you now have an annual commission coming off, which is still maybe 1%. Now, there's what they also call C shares. Now, where you have a C share, there's nothing up front, okay? There's nothing on the back, but there's maybe an annual commission, again, of maybe 1%. Now, some might say, why wouldn't I do a C share over a B share? Because I got no backload. Well, understand that most people that go into C shares, they're in it for just temporary reasons, okay? And so they just want to be in the account and out, and so they don't mind just a commission being charged while they're in the 1%. But they don't want to see a front load, back load. Now, an account like that is going to have much more in cash because people are coming in and out of it, might not perform as well as an A or B because it's not fully invested. Now, for retirement accounts, most people want to do A because they're in it for a long period of time. They don't mind paying this up front on the deposit, but forevermore just pay 1/4%. So hopefully this kind of gives you a feel for these class shares and how they charge commissions. If you want to understand your portfolio and want to know what your share class you have, then give us a call.
What a great show. You know, so many different topics that we went over today. I hope you found some of those very valuable. If you've taken anything away from the show today, remember, plan, plan, plan. Have a retirement plan in place that can help you achieve those goals you so desperately have worked for all these years. You know, we've talked about all the different tax things and the different investment vehicles out there, and when can I retire? You know, we're here for you. Our specialty is helping folks plan to retire well. If you haven't called us before or haven't sat down recently with a financial advisor, we'd love that opportunity just to sit down and walk through that with you and how maybe you can best put together a plan so you can achieve all those fun things you've dreamed about doing in your retirement.
You know, Art, it's interesting. We've been doing the Retiring Well television show here for over 9 years in northern Michigan, and perhaps you've been watching the show. We get a number of times where folks have been watching it for 2, 3+ years, and they say, well, it was finally that time where I thought it might be a good idea to give you guys a call. And so we encourage you, you know, don't hesitate to give us a call. We're happy to discuss your retirement plans and see if we could provide some help along the way. So thanks again for tuning in to Retiring Well.